This is America's Roundtable from Washington, D.C., a weekly radio program with leading voices from America and international thinkers representing the academia, business, media, think tanks, and the political arena. I am Joel Anand-Samy, your co-host, joined by Natasha Sardoj, an economist and co-founder of the International Leaders Summit and the Adriatic Institute for Public Policy. We extend a special warm welcome to our special guest on America's Roundtable this weekend, Dr. Marc Miles. Marc Miles has researched and written about global markets for more than 30 years, and prior to becoming a global strategy consultant, founding Global Economic Solutions in Boston, he was the director of the Center for International Trade and Economics of the Heritage Foundation in Washington, D.C., and editor of the annual Heritage Foundation Wall Street Journal Index of Economic Freedom. In that capacity, he traveled widely throughout the United States, Eastern and Western Europe, South and Central America, and Hong Kong, working with government officials, business people, think tanks, and students. Dr. Miles began his career at the Federal Reserve Bank of New York, followed by a research and teaching career as a tenured professor at Rutgers University. During that time, he wrote numerous scholarly articles and 3 books, including International Economics in an Integrated World, with author B. Laffer, and Beyond Monetarism, Finding the Road to Stable Money. And after leaving the academic world, he was an advisor to institutional investors at several investment research and forecasting firms, focusing on pending investment trend shifts in both equities and fixed income. Dr. Miles' articles on globalization and our financial and commercial markets have appeared in the New York Times, the Wall Street Journal, and the Boston Globe. And he holds degrees from the University of Chicago with a bachelor's, master's, Ph.D., and a Master of Science degree from the London School of Economics. It is a great delight to have you on America's Roundtable, Dr. Miles.
Good morning, Dr. Miles.
Good morning. It's good to talk to you again.
Consumer confidence improved from August 61.3 in August to 70.3 in September. And historically, looking from 1967 until 2012, the United States consumer confidence averaged 93.2. However, the index is based on, is reflecting consumers' perceptions of current business and employment conditions, as well as their expectations for 6 months. In your opinion, how can we look at this consumer confidence improvement? Is there possibly a factor of potential change of administration?
I don't think there's been a lot of reasons to be confident. As I was saying, what's going on in Washington is nibbling around the edges of what we already have. There's no great leadership in terms of making major changes. In fact, the parties are discouraging members from proposing major changes. The American people are not stupid.
Right.
They see what's going on.
Indeed.
And they say, where's the long-term solution? So it doesn't surprise me that consumer confidence is the way it is. Mm-hmm. Back in 2009, when the so-called stimulus program was proposed, and that was, $800 billion or so, I wrote an op-ed in which I pointed out a much less expensive, much more direct, much more efficient way of handling the current, or what was then and continues to be, gloom in the economy. And that was to cut the corporate tax rate. And my thinking was quite simple. First of all, our corporate tax rate's the highest in the world. Secondly, cutting a corporate tax rate actually has positive effects on the very areas of the economy that were lagging. If corporations have lower tax rates, they have an incentive to produce more, because that will produce more profits. And in producing more, they will need more machinery, they will need more workers, and that would pull up the capital market and alleviate some of the unemployment. As corporations begin to earn greater profits and the outlook for their profits improves, the stock market would rise. And a major part of the current funk or our decline into it had to do with people looking at their quarterly 401k statements and seeing that their assets were disappearing. Mm-hmm. If we could make a change in policy that would reverse that, it would have a very positive effect on spending. The last point is that cutting the corporate tax rate in 2009 would cost very little. Corporate tax revenues in 2009 were significantly below what they had been in other years. So, as they do the static cost analysis of that program, it would only amount to, a few hundred million, not 800 billion. And so for a far less cost, we could have a much bigger bang in the economy, and I think we would be better off than we are today.
Dr. Miles, this past week, 15 CEOs from the country's largest banks and insurance companies sent a letter to the White House and also to the U.S. Congress, and they requested a bipartisan deal to avoid the approaching fiscal cliff. And it's interesting that one specific text includes these words here. It states, and this is written by the 15 CEOs, it says, the consequences of inaction for stability in global financial markets, for economic growth, for millions of Americans still without work, and for the financial circumstances of American businesses and households would be very grave, unquote. And the letter was signed not in any manner to support one party or the other, but communicating a greater concern. And as you've rightly mentioned, there is an uncertainty for entrepreneurs, for small businesses and others that are uncertain as to what the next 5 or 6 or 7 months will hold. And therefore, with the lack of certainty, there isn't much productive work being done.
One of the problems of the way we approach problems, or economic problems, is to look only at the current situation. People say, this year we have a deficit in spending. Over the last 2 years, the total amount of debt in the economy has grown by X billion dollars or X trillion dollars. I think that's a very myopic way of approaching the policy, because the problems we have today did not suddenly occur today. Mm-hmm. They've been occurring for a long time. Some of us have been watching the unfunded liability of Social Security and Medicare since the late 70s. We knew this was coming. A lot of people knew this was coming.
Right.
Corporations knew it was coming. That's why a lot of corporations shifted to 401k plans. And we haven't taken any efforts to keep it from getting worse. Some of the other problems that we have today, such as the high cost of health care for corporations, stem from the 1970s. In the 1970s, we had high global inflation. And that was essentially caused by the breakdown of the Bretton Woods system, mm-hmm. which in turn was caused by the Vietnam War in the United States and the inability of the U.S. to maintain its peg of a gold at $35 to an ounce. So in some ways, we are still feeling the remnants of the Vietnam War. So you can't look at this simply in terms of the current situation. In the 1970s, when inflation went up, capital costs went up, whether you're looking at corporations or governments or private sector or nonprofit sectors, suddenly payrolls ballooned because labor was relatively less costly. And labor began to demand, because of bracket creep, the fact that people would be pushed into higher tax brackets by inflation, they began to demand things that weren't taxed. Healthcare benefits. And you got the explosion of healthcare coverage by various sectors in the economy.
Indeed. Mm-hmm.
And because corporations and governments didn't have money to pay workers at that time, their revenues were really crimped because we were in recession during this high inflation. They started making promises that, we can't pay you today, but we'll pay you tomorrow. In other words, they made promises about future pension benefits. And all of these changes from the 1970s are really coming home to roost in the current environment. So there are many problems that need to be addressed, much more than is being discussed in Washington.
I mean, Social Security reform has been implemented in many of the countries of Eastern Europe after transition, and the pay-as-you-go system is obviously doesn't work because it eventually goes bankrupt on future promises, as you mentioned.
Democracy does have some drawbacks, that there's always an incentive for people in power to promise voters more. And so we find them increasing the benefits of Social Security or Medicare, but not raising the taxes because that's not popular with the electorate. But, as Churchill said, democracy is an imperfect system, but it's the best one we have.
Indeed, that's for sure.
It's
Dr. Miles, you've just clearly explained to us and our listeners about how decisions and policies originating from the 1970s have basically come to a head and are affecting each and every citizen of this country and each and every taxpayer, and how your response to the issues we face today has to be approached with a more of a broader look and a more strategic effort, not just only dealing with one specific sector, but looking at a what we would consider a major endeavor of real principle reforms, specifically looking at that long-term focus.
Dr. Miles, we would like to hear your comment on the Fed's policy to purchase $40 billion a month of mortgage-backed securities until the job market has improved.
Well, my comment on that is it certainly will benefit people who want to refinance their mortgage. And mortgages are at an all-time low. And incidentally, that helps reduce the mortgage interest deduction. However, do I think that the Fed's efforts right now are likely to have a major effect? I don't think so. One thing I will agree with Keynes about is that at some point, the Federal Reserve pumping more and more credit or money into the system has little effect. Keynes described it as pushing on a string. Or, as I like to say, you can take the bankers to the money trough, but you can't make them drink.
Indeed.
And you extensively wrote on free trade. I also mentioned many times the reliable keys to growth, low tax rates, deregulation, limited government, and especially free trade. And all these points are mentioned in the program of Governor Romney. Governor Romney mentioned we need to get China play by the rules, and that's what his intention is. Our question to you is, how can the U.S. make China follow the rules of international trade, and what policies should be taken to curb abuses of fair trade?
Well, I guess I'm not as worried about that as Governor Romney has been. I think this is one of these passing concerns. People see they're losing jobs and they turn around and they would like to blame somebody. And China becomes a likely target because a lot of production had been shifted to China. But we're seeing a reversal of that movement today. More and more production from American companies is being returned to the United States. Part of that is the rise in the price of energy, and therefore transportation costs have gone up. Part of that is hiring labor in the areas of China, around the borders where a lot of this manufacturing has occurred, has risen quite a bit. And that's why China is trying to move more and more production into the center of China. So the relative costs of production have gone down, and the United States is actually recouping some of that work, some of the work that had been offshore. Again, markets adjust. Things don't go on forever. Entrepreneurs find a way to take advantage of the current situation and turn it so that they can make a profit. And I think we're seeing that in the U.S. economy.
Dr. Miles, as we close this particular segment here today, and for our listeners that have joined us, we are delighted to have Dr. Marc Miles with us this weekend. He has researched and written about global markets for more than 30 years, and prior to becoming a global strategy consultant, founding Global Economic Solutions in Boston, he was a director for the Center for International Trade and Economics at the Heritage Foundation in Washington, D.C., and prior to that, he began his career at the Federal Reserve Bank of New York and was followed by a research and teaching career as tenured professor at Rutgers University. And in closing, what are your thoughts about our economy and the way forward as far as policies are concerned, and as you mentioned, what lawmakers or legislators ought to do in addressing America's key issues, key problems?
Given the situation today, the best we can hope for is growth around 2.5%. Mm-hmm. Some quarters will be below that. We might have some quarters above that. But we're going to have growth below the trend of the last several decades. If we want to change that, if we would like to expand or accelerate the rate of growth in the United States, we've got to make some fundamental, major changes. And we'll know when that is going to happen when the politicians in Washington come together and create a policy that takes care of the unfunded liabilities from entitlements and lowers tax rates and reduces deductions so that, in fact, there can be more tax revenue or solving the problem of our deficits. And I'm hopeful that this will happen. I certainly can't guarantee it will happen. And I think if it is to happen, it's most likely to happen in the 6 months after the presidential election. So this is a time of hope. We've gone through some pretty bad times in the last 4 years, but I think the next few months is a time of hope. I would just say that encourage, if you're in the United States, to encourage your congresspeople, senators, representatives, to make those major changes.
Thank you very much indeed, Dr. Miles, for joining us this week on America's Roundtable.
Thank you, Dr. Miles.
And
My pleasure.
And Dr. Miles' articles on the globalization of financial and commercial markets and the economy have appeared in the New York Times, the Wall Street Journal, and the Boston Globe, and we encourage our listeners to visit the web and certainly read these excellent articles and op-ed pieces from Dr. Miles. This is America's Roundtable. Visit us at americasrt.com. Follow us on Twitter at americasrt. You can find us on YouTube and Facebook. Like and share.